It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. So let's take a look at Roku for our Your Stock, Our Take segment. A question came in on Roku, symbol ROKU on the NASDAQ. Trades around $77, market cap about $10.6 billion. What does the company do? Roku, they operate a streaming TV platform. Roku devices are small streaming boxes and streaming sticks that connect to your television. The company essentially puts streaming content from Netflix, Spotify, Hulu, Disney Plus, and more with subscriptions required in an easy to search place on a TV screen. They've also started producing their own content. So Roku was a pandemic stay-at-home star. It's down 70% year to date, 83% from its 2021 highs. On Thursday of last week, the stock dropped another 23% after it reported Q2 GAAP earnings per share of 82 cents negative, which is a miss of 13 cents. Revenue was $764 million. That was a miss by 40 million. So adjusted EBITDA in the quarter was also a loss of $12.1 million, down from a gain of $122.4 million. Strong historical growth rate that we've seen from this company, but minimum to negative operating income historically. While the negative turn in operating income and adjusted EBITDA, as well as weaker revenue growth in Q2, were not ideal. What really crushed the shares was management's Q3 go-forward outlook. The market is always looking forward. They cited a weak economic environment defined by recessionary fears, inflation pressures, rising interest rates, and ongoing supply chain disruptions. The company then guided for net revenues to increase only 3% year over year to $700 million. Adjusted EBITDA would be negative in Q3, $75 million from a positive $131 million in Q2 2021. The company also withdrew its full-year revenue growth rate estimate. From a valuation perspective, Roku trades with a price to sales of 3.15, which is significantly below the tech segment, but it is not profitable on a GAAP basis, and its enterprise value to EBITDA is in the range of 150. It will go higher in the near term as well based on that guidance. In the end, the company has great products. I've used them, but despite the massive share declines, the valuations remain high, and the stock does not meet our criteria of growth at a reasonable price. Growth is slowing. Earnings remain elusive for this company, so we'd avoid it. It just doesn't make our criteria right now.